Hello, everyone. Welcome to the California MBA Mortgage Quality and Compliance webinar. We're very excited to have you here. And first, I would like to point out our wonderful sponsor, our committee sponsor this year, which is Crosscheck Compliance. They are a nationwide consulting firm providing regulatory compliance, internal audit, fair lending, loan review, and litigation support services. And also, Monica herself is a fantastic resource and someone to get to know. So today, Michael, who is the president and founder of MQMR, and myself are very happy to have this wonderful presentation about California state exams. But before I delve into that, I need to remember to mention the Legal Issues and Regulatory Compliance Conference. We're very excited. Mike Flynn of the Legal Issues Committee and I are talking about it all the time. We really want to make it really beneficial and helpful to you. There's so much regulatory focus on us right now. There's so much pressure on the compliance and risk and legal for all of the ideas coming to us in our current environment. We need all the help we can get, right? And we need to be able to talk to each other and compare ideas, compare notes, and ensure we're on the same page as an industry. So please, we would love to see you at the conference. It's December 12th and 13th in Orange County, really close to the airport there, and very convenient. Love to see you. So today, California state exams. California is a very thorough examiner. So this is a very important topic. I'm very glad you guys are in attendance. We have Jerry Hager, the Executive Vice President of Legal from AmeriHome Mortgage. We're so glad you're here to give us the lender perspective. We also have Raymond Sneitshevel, the COO of First Line Compliance, a great company to work with if you need assistance. So glad you're here. Please take it away.
Yes, good morning, everyone. Right?
Yeah, thank you very much, and thank you for having me. Appreciate it. So, exams. Jerry, the way we're going to do this is so thank you, by the way, for having us. Glad everyone's on the call or on the webinar. You know, our goal here is to touch on certain subjects, you know, mostly for California, almost exclusively California, but a lot of the thread will, of course, affect other state examinations as well. So, and I guess we have some Q&A. If we have Q&A time, you can ask about other things as well. But we're trying to focus primarily on California, but you know, a lot of states are getting very active. So we kind of start with talking about exams generally. Jerry, any initial thoughts on where we want to go with this?
There are some states that are certainly more difficult than others. California is typically in the worst 5, I guess, for being pains. And but a lot of these things would also apply to the other states that are exceptionally difficult. California, of course, has some special things it likes to hit you on, which we'll be discussing. But what I've also found is the examiners tend to be pretty professional and not that difficult to work with, although what they ask for can be a major challenge.
Yes, and I know we were just talking about this, about the state examination cycle. I would say historically with California, other states as well, but historically with California, you would see that getting the final report sometimes takes a long time, and that itself is a challenge. They're getting better on that is what I have seen. I think they've been, I want to say more professional. They've always been professional, but they're more responsive in some things than before. So that's pretty much you know, kind of an improvement, if you will, from where we were before. But I have seen where examination reports, you know, you take your next exam after, you know, in 2 years, and you never got the examination report from the last examination. So that was a challenge. So they're getting better at that. I do want to say that. Now, talking about exams generally, you know, for me, you know, state exams, if you've done a few of them, you get the rhythm. So it's pretty much routine. If you do most of the right things, the exam's going to go fine. By the way, when I say most of the right things, we all try to do as much as we can to get it right, and that much I do respect. But it also depends on resources. If you're a bank, doing the most of the right things is going to be a different measure than if you're a small shop with one compliance officer or compliance analyst. So don't expect that we can cover everything all the time. But if you at least go through some of the key factors that you try to run things in your company, for the most part, examinations are routine, and it's going to be fine. It's nothing to lose sleep over. Well, unless you know something we don't.
Unless it is, right.
Exactly, there is, exactly. I think that with their exams themes may differ. I thought that was important. I know with the DFPI, my experience has been maybe it's depending on examiner. I recall with the client having an examiner come in, and he was really going to do it really was more of the accounting, which we'll talk about, but really the accounting kind of focus. That was his approach. I know this because he wanted everything in paper, nothing electronic. So my client had to spend, I don't know, 2,000 pages at the copier that we never use. I was sitting there with them copying the reports, et cetera, that we had to give to him because he wanted to stack all through the office that it was an on-site examination. So he was looking at accounting. Other people will look at per diem. We'll talk about it as well. Sometimes it's more focused on that, sometimes not. It's a hit and miss as to what the focus will be. I'll even go so far as to say some states will specialize. You'll see that they have a thread. I recall that Idaho, I think it's Idaho, has a thing for ECOA.
Yeah.
So again, some states will focus on different things than others. Just know that they have themes. It's not a big deal. It's nothing personal, especially if you get California, one time's accounting, next time is per diem. It's just the examiner, and maybe it was a direction they wanted to do, who knows. The last thing I want to say is, and not to deflate anything here, I'm always cautious about a good exam might give false sense of security. And by that, I mean, you'll have you'll have a lot of state exams where, hey, you did really well, only 3 findings, everyone's happy. And by the way, this worries me because the CEOs know, look, maybe we're overstaffed in compliance. No, we're not. There are a lot of things that state examiners do not touch. They didn't necessarily touch your TRID or your adverse actions or your appraisal review or independence. There are certain things that we always have to work on, and that you have a lot of good exams is great. It's what you want, but I'd be cautious that it's the measure that your compliance is 100% or even 95%. They're looking at key things, and their specialties might not be on the things that you lose sleep about. So I just want to be sure and kind of mention that as well. Next slide.
Something to really watch with
Go ahead,
that is keep in mind that an exam is not an audit. Some of them actually say that in the report, because they are not representing anything. That they're just representing what they found, which of course relates to what they looked for. And there may be some real problems in there. I've worked at some places that had some major problems. It was not necessarily found in exams. And for some reason, sometimes the CEOs like to wave around exam reports, which technically they can't even show anybody, as, look, we passed these exams, we must be in really good shape. And that doesn't work out very well.
No. I appreciate the confidence, but I remind them that there's a lot of things we have to look at, and state examinations, like you said, aren't necessarily it. Again, any thoughts on this? You jump in, Jerry, if you like. But the pre-exam requests and questionnaires, we take those very seriously. Of course, that's going to give you a roadmap as to where they're going. Some of the things I'm going to talk about here, and Jerry as well, is probably based on what we heard from our clients in the pre-exam stage, not the post-exam stage, about what we think where they're going. I would say answer everything completely. Give as much of the information as you can. If you can't get the information, sometimes they want to report with 18 items, and for whatever reason, you don't capture that 18th item. Generally, that's going to be okay. I have noticed a state that was offended by that and wrote up my client pretty badly because we were not able to get the 18th item. And had we known, we probably would have, really got IT to get that information. So don't underestimate what they're looking for here, but don't stress too much. You have to get balance. What I often do with my pre-exam responses is saying, here's what I have. Here's the quirky thing I couldn't get. If that's going to be a problem, please let me know. And at least I have a hedge for them to say, you know what, we really need it. Okay, I'll go get it, right? As opposed to
it gives you an opportunity to negotiate with them about what is it they're really looking for. And after you do enough of these, you get a pretty good feeling of what it is they really want to see. And that tends to help a lot. Because usually if you can provide them their answer, and the backup for it, they'll be fine with that. It's when they think you're trying to hide the ball that they get really upset.
Yes, absolutely. I don't, your thoughts, Jerry, on extensions? Mine are, I'd rather not get them if I can. I've done it once,
Yeah,
but what are your thoughts?
we try to avoid them. I mean, we're licensed in 21 states now. It used to be 48 before we got bought by a bank. And rarely try to get extensions, except possibly for a certain piece of information if we're having trouble scouring it up. Extensions to do the initial response, we've never even asked. Try to get everything in on time if you can.
Go ahead, Jerry.
Go ahead. You started to say something.
Yeah, and I was going to say, I did ask for I thought this was fun. I did ask for an extension from the DFPI on March 2020 to get the final response. If March 2020 rings a bell to you, it rings a bell to 7 billion people. I said I need an extra couple of weeks to get this done because my client, I was on site, we're transitioning to being off site, and I'm trying to, we're working on that. Can I get a couple extra weeks? And it was surprising how reluctant they were and saying, fine, we'll allow it, but that's not what we generally do. You should really try to get it on time. And I really had to answer them, are you serious? This is, this was a bit of a pandemic, and we'll get to you on time, I promise. So, and we did. They'll give it to you, but I don't think you should work it into your program that you'll get extensions. I think you need to aim for that deadline. Always keep the examiner happy is probably that's the key thing, I suppose.
Yeah, and what you're finding now with California is they do have two setups for exams. One is if it's a multi-state exam where they're doing it in conjunction with usually some of the other larger states, they'll be using the SCS process. But if it is not a multi-state exam, it's the same process they've always used, and they tend to use different examiners depending on which flavor it is. So, and strangely enough, we're large enough that I thought we would end up in a multi-state exam, but it hasn't happened yet. We recently concluded a California exam and they used their normal team. So you never know how it's going to play out. And as far as on-site exams making a comeback, as far as I know, in California, they're all still operating remotely. I haven't heard anything about on-sites. We are starting to see some on-sites in the federal space, which is relatively new, but who knows? Yeah. I'm sure they will eventually, but they all seem to have gotten used to working from home.
They are, and I will tell you that I have heard of a client, one of them is doing it on site. And even then, speaking to their compliance officer there, we thought that was kind of peculiar. So I think it's kind of unique. The DFPI is going to do on site. I think there's a history with the company. That's a good company, but they had some issues. Sometimes we'll have issues. But anyway, so maybe there's a reason they're doing this in particular, but they are doing it on site, but that's the only one I've heard of. So I don't expect to see many of them, but people might come back. I will tell you that, and Jerry, you know this too, the East Coast regulators probably would look forward to doing on-site somewhere between November and February. They all want to come to California. So, so that's when they love coming out. Yeah, but other than that, who knows? So.
I remember doing a New York exam once where they actually had field trips planned to Disneyland and other places. So they worked it into their work schedule.
A happy examiner is a good examiner. So
they were very unhappy examiners. Yeah. That was a long time ago.
Yeah.
Now the DFPI really gets into accounting, and particularly the information involving, as in the next thing, third-party fees, how you handle escrows, how you transfer the escrow money around. Ray was commenting a few minutes ago about them getting heavily into stuff. I remember they sent 3 examiners once at an on-site going through everything, and unfortunately they had put a relatively junior person on it who did not get it. And finally they called in a senior person who explained it all to her, and it ended up okay. But you really need to have all your ducks in a row on the accounting and the third-party fees. If they see anything that does not look right, you will get written up for it.
So yeah, my sense is probably more than any state, they are going to look at the accounting. Again, sometimes that's heavily accounting focused, sometimes not. But when they do, I'm not a CPA, so I couldn't tell you, but I believe that their accounting requirements are beyond the requirements for GAAP or other states and so forth, what you have to maintain. And that has to do with like the trust accounts and reconciliations. They want to see the hourly reconciliations of the trust accounts. Yes, I'm jesting, it's not an hourly, but it's I think more frequently than usually a company would do. And usually clients, in my case, my clients are smaller companies, they're not staffed to do, you know, monthly or whatever it is as frequently as the state might require. So they have to make some adjustments. But one of the things to think about is, you know, then knowing that, you know, maybe having a separate California trust account rather than a general trust account for all states, maybe California specific, and be able to reconcile that within the requirements. Again, I wouldn't do it hourly, right? But we have to make sure that we understand, accounting needs to understand what the requirement is. So have a conversation with them. And what I often have done when it came to accounting, I stay out of it. As soon as there's a question about accounting or a finding, I'm a compliance attorney, I've been chief compliance officer, I've been general counsel, I know my limits. And numbers is not my strength or how to move accounts. So I get the CFO together with the examiner to have the conversations and not trying to inject myself too much. But I think that's something that we want to be careful of, is the accounting piece, and just the reconciliations are very particular about that. So be prepared for that. In regards to third-party fees, it's always been an issue. A lot of states are into that, but I think California really thrives on that one most, and the nickel and dime. Can you show me the receipt for the appraisal? You know, it's an invoice, but let's say the receipt, right? Can you show me the receipt for the credit report? Be prepared to do that. Most of us can do that. The one challenge I'm seeing, and this is just operational, and that's the recording fee. Because that requires I need the recorded deed of trust. That's the stamp, that's what I use. So as you're going into an examination, how lucky do you feel that you have everything back and that you've reconciled them? So I think that's really the tricky one, is the recording fee. So be prepared for that. Or if you know examination's coming, you know, really get in front of that. In fact, let's talk briefly. This is kind of out of sequence here, but let's talk briefly about you know, when you want to do remedial action. If you notice that it's always better to find an issue yourself and remediate it as soon as possible. Not because you have, not because you see an examination request coming in or notice, not because you're in the middle of an examination, and not because the examiner told you to, but it's because you were able to get it done. It was something you picked up on, remediated quickly. So in the same guise here, get ahead of it if you can, and go ahead and get the recording. If you know you've got a problem with the deeds, that get on it before you get the notice is best. Second best is when you get the notice and do it before they show up. So, but again, so if you look at you've got some kind of reconciliation issues, maybe get those done before you get the notice is my preference. Next issue, next slide. There we go. Jerry, thoughts on loan officers and how they make our life better?
Well, I guess they make our life possible, but
That's exactly right.
they, as far as not being at the branches, we have found great challenges with that. Among other things, the availability of the various systems they need remotely can be a major challenge. Whatever kind of recording systems there are for phone calls can be a challenge. All sorts of things. Our experience was most people really wanted to stay at the office, and we reconfigured our office to allow them to do that. Going forward, we're certainly seeing more people remote, but this is more remote in the field and not that terribly different than it's really been in the past. We get it a little bit lighter because we're on the federal side now, and things are easier with the very examiners, and they don't technically examine the loan officers, but still we have to follow the general rules. And I think having the people remote is both a good thing and a bad thing. Among other things, you do have a fairly serious lack of day-to-day control.
And I think that's going to be key. I mean, you know, in light of California rule now has changed, or the law has changed, that we can have people remote, including loan officers. I think they kind of highlighted, you know, what the expectation is, and it's these two items here: full control of information security. That's how I look at it. So really controlling the information, and that might include, you know, not having a loan officer be able to print at home. Why does he need to print? I mean, if he has to, he has to, but but then of course, if you print, then you have to make sure they have a secure trash can, right, or a shredder. And I'd rather them just not print and create the risk of having a shredder at every location, everybody's home. So information security, I think, is key, and supervision of the remote employees. I think that's when, again, in an examination, when they say, okay, fine, you can be remote, we recognize that's the law, but how do you manage it? I think these are the two areas they're going to hit. And if you can demonstrate that you have control of your employees, and we do anyway, it's not as if if you're on site, you get trained. If you're off site, you don't. No, we got Zoom. We have everything is recorded. Training material, whatever it is, they're all going to be subject to supervision anyway. But I think that's what we have to show, insofar as yes, they're not in the branch, or they're not local anymore. So either the corporate or at a branch point, a branch location, but we are still doing what we're supposed to do and show them how they do that. So I think in an exam, they're going to start questioning that. That might come up as we go along now that things have changed, and we have to be able to answer that. I added, and we had some thoughts on this one, Jerry and I, before, but they were briefly talking about this, but in a kind way, loan officer continuing education enforcement. If you recall, there was a case less than a year ago where multiple states, and I want to say headed up by the DFPI, went after loan officers who went to a particular education vendor to do their continuing education, who did shortcuts and did things that allegedly they were doing that they weren't supposed to do. And as a result, the loan officers were the ones that were hit. What do we glean from that? What I gleaned from that, and again, expect for examination, there might be questions about continuing education. How do you know they go to the right vendor? What happens if you find out someone hasn't completed it or cheated on continuing education? What are your steps as a company to remedy that? I don't know that we know the answer to that. In other words, if you know someone hasn't completed it, do you fire them? Do you have them take it over again? What is the DFPI looking for? But the point is that could come up insofar as managing your loan officers, and that particularly continuing education. What do you do about that, and do you have controls for that? So I think that could bubble up in an examination in light of the enforcement action, in light of the fact that the DFPI was one of the quarterbacks in that whole thing. So those are my thoughts on pretty much on loan officer location. I mean, I think we'll be okay, but those are new questions that are going to come up now because things have changed since certainly 3 years ago.
Yeah, things they change. The other interesting thing about the enforcement is, and what if one of those people applies and they have this written settlement agreement with the DFPI, and it may seem to indicate that they were doing unlicensed activity, or maybe not, who knows? And there's a whole bunch of other people that have been cited, but they don't have an agreement yet. I mean, it's quite the mess. And
It is.
What we do is control that using a known provider, and feel that probably works the best. Next page. So in an exam, one of the first things you're going to need to think about is what kind of license do you hold? Because the disclosures vary, and you need to make sure you're sending out the right loan packages.
But Jerry, it's easy. I went to a doc provider. They gave me all the right disclosures.
Yeah, I'm sure they did. And they
Yeah,
probably
sure
gave you a gazillion that are useful, and more than that aren't. And
right.
A bunch that don't apply unless you're standing on your head looking through a fishbowl or something. So it can be a real challenge to get everything set up right. I think most of us use this one particular provider that's pretty good, but you still have to check all the right boxes. And sometimes some places have multiple licenses, and which pad are they wearing at the moment? Things can get pretty confusing, and having it set up right makes all the difference in the world.
Yeah, Jerry, I think you hit a point there. I think that's important, and that's that you're right. They're going to have more than one license. They have the DRE and the RMLA, or they have the CFL and the RMLA, or the DRE and the well, anyway, they pretty much got them all, I think. But you get the idea. And the RMLA, when you're looking at DFPI for RMLA, I believe their modus operandi is that they will assume that everything is RMLA unless you say otherwise. They'll just presume that. So they want disclosure, et cetera. If it's not in there, then hopefully you did it under another license or for whatever reason. But the easiest way to handle that, of course, is you do have a specific need for DRE versus CFL when you're brokering out, something like that, right? Because you have limitations with brokering on CFL with the licenses. So I can see it, but then only do it in that case, right? And be able to bifurcate your pipeline based on, well, this was under DRE license, this was CFL, and that's why I have different disclosures in it. and be able to operate that way. So when you're doing an examination for the CFL, for DFPI under CFL, then give the loans that's under their auspices and not otherwise not under auspices. So I think that's kind of key, and that kind of drills into the disclosures. That's how they'll notice the difference. That and maybe some licensing numbers. Jerry, as well that DFPI is not really amused with blanks and unsigned. A lot of states don't like the blanks and unsigned signature lines. And Jerry, now you and I both know if you got a signature line you don't need, what do? Yeah, take it out.
Yeah, you
take
take
it out of
it
the
out
document.
or make a cross through it with a note, signature not required. Do something so it does not look like a space that is not supposed to be there.
Yep.
And you can expect that they will pull a sample of every flavor of loan. And there will be 10 or 15 or 20 of them. They'll pick them relatively randomly, and they will grind through those files. Pretty much all the regulators on the West Coast are famous for that. And if there is a problem, they will most likely find it. And you really need to make sure your loan files are clean. Hopefully all the disclosures are right, and there's nothing there that's going to jump out at anybody. And they know where to look for the stuff that doesn't jump out. So if there's a problem, it's likely that they're going to find it.
Yeah, we had I've had a couple situations with clients where I think it was the HUD disclosure. We didn't have the HUD counseling. So the paper, the good news is the disclosure went out. The bad news is we didn't list the client didn't list the education providers, the possible education providers in the area. And you get and it used to be there, but now of course it's gone. So somehow some glitch, some fix in the LOS system kind of wiped it out. We had to fix it. That was one where the client picked it up themselves, fixed it themselves, and that was a good story every time. In looking at a loan file grind, somebody picked it up. We said, fix it already. We discovered ourselves. Thank you very much. But that's why it helps to see that. But they'll pick up on that. In California, we all know we've got the Fair Lending Disclosure, the Holden Act disclosure, whichever you want to call it. And on that disclosure, it's going to ask you to list the applicable regulator, and if you have any concerns or complaints about fair lending. I think a lot of lenders will get caught in that net because it'll say that they're DFPI licensed and they'll have a DRE office or something to that effect, or both the DRE and the DFPI. Make sure that in that case that the right regulator is showing up, just so that when they do get the examination, it's easy, it's done. But that's one that often gets caught in the net simply because someone hasn't paid attention to put the right address for the appropriate regulator on there. And the DFPI, I think that's what, on day one, they probably go to that because they know they're gonna, not that they're out to get us, it's not a witch hunt, and it's not gotcha. But anyway, maybe that's where they go first, who knows? So anyways, that's what I would expect on that. Any other thoughts on that or experience on that, Jerry?
That's been pretty much my experience as well. Yeah. That does seem to be one of the first things they look at.
Yep. All right, next slide.
Yeah, here, the reports. There's a lot of reports that you need to file. There's the California annual report. Depending on the flavor of your institution, there may be several California annual reports and their version of the HMDA report if you're small enough. Don't forget, of course, the quarterly call reports and whatever other reports they may request in the meantime, like all of the more recent COVID reports. And by the way, the deputy commissioner, I spoke to her a few weeks ago. She wanted to thank everybody for timely filing all of those reports, which hopefully will not come back to bite anyone. The thing that has been popping up quite a bit recently is not only do they expect the reports, but they actually look at them and they do analysis based on them. And they expect that, among other things, they tie. So if you have a number at the end of quarter one and then that's supposed to pick up in quarter two and those numbers don't match, they're going to notice that. If you have stuff jumping around or things may have moved at year end and your year end quarterly report was filed with X number on it, but your annual report comes up with a slightly different number because there was an adjustment, they're going to find that. And it's best to take a look at those things and get ahead of them. Make sure you make those things first. They tend not to yell about those a lot, but if they happen a lot, you'll hear about it.
Right. And I think, and again, and interestingly enough, the when we talk about numbers like we did before, numbers don't lie. So it's one of those things that if you're getting a mortgage call report, we all know it's a challenge for mortgage call reports sometimes, because and that has to balance quarter over quarter. So when you report something separately, you know, you have to make sure they balance. And that's an easy one, and rightfully not necessarily a bad question to ask. Why did you report this many fundings, you know, in this month, and that many in that funding in 2 different reports? Now, sometimes the scope of the question is different, right? So that might be the reason, and we articulate that, and that's okay. And other times it might be, well, we didn't really get our mortgage call report correct, and we have to do corrections, and they allow for that. So maybe you go back and you make the, you know, the corrections on your mortgage call reports. We know we have to go back and fix those, and so on and so forth. You know, go back, what is it, 8 quarters or whatever it is. But be key on that. At this point, I think we should be good at our numbers. I will tell you, one of the hardest things that we deal with, and maybe sometimes people don't appreciate, is, for example, you know, how many funded loans did you have? And if you ask accounting, funding, and legal or compliance that question, you get 3 different answers possibly, because funding means 3 different things. We mean in compliance, which we expect the regulators are expecting, is disbursement. You know, where accounting thinks that we funded into the escrow company, and funding will tell you that I sent it out to get it, you know, to get the funds sent out. So it depends. We have sometimes just the call of the question, what are we asking? And sometimes we look at it from that way. So I think that's really important to keep in mind. Make sure the numbers balance as much as you can. If they don't, explain, or at least say you're working on it. But you know, they're not going to be wrong about that. If the numbers aren't there, we have to kind of reconcile that. So I think that's okay.
Yeah, and one thing to keep in mind, and they don't publicize this very much, but the version of the call reports that the states see have some automatic quarter over quarter comparisons. So if there is something that doesn't tie, they basically get a report saying, hey, these numbers don't match with what they said at the end of the last quarter, and you'll hear about it pretty quickly.
Yeah, and I think you briefly touched upon it real quick on that Holden report too. There's, you know, if you haven't filed your HMDA, sometimes you have to do the Holden report under the Holden Act. So don't forget about those. I think some lenders might not know that, but you still have to report kind of a HMDA-esque report. And it's due at a certain point. I think it's March 31st. This last couple of years, I think they had to push it back, and that's because the DFPI, I think they finished it, but I think another agency had to approve it, and there's a little bit of bureaucracy, so they had to push back the dates, and they were gracious about it. So eventually people filed it and took care of it. And I think people were very diligent, at least letting the regulator know, letting the DFPI know, we want to submit this, we just can't. And they're aware of that. So at least we were active, and I think they were very good about that. Anyway, that being said, don't forget that it's the Holden report. If you don't file HMDA, you do have to do the Holden report. Pretty straightforward compared to a HMDA report, but don't forget it needs to be done for those who otherwise don't file HMDA. And even then, you report somewhere else that we did file HMDA to the department to make sure they know that you've done it and they're not expecting it. So next slide. Well,
Per diem, yeah.
Yeah. Look, the requirement for per diem makes sense, and you would think by this time, and I want to say that as an industry we're doing better. We're doing quite well. I think, Jerry, you and I have been in this industry long enough to know that this per diem issue, you know, happened 20 some years ago, I think, and we keep trying to figure out what do you want to do with it, how do we reconcile it. We recognize that the requirement is you only should get 1 day's worth of interest, except when over a weekend when they sign it. We get all of that. So there's no desire to collect, as far as I know in my experience, there's no desire to collect more per diem than we're permitted to do. It's really more the operationalizing the compliance piece is a challenge. So so California, you know, focuses on this, and you know, again, it's a key consumer protection, so I can respect that. But sometimes the requirements and what we have to do with it become a challenge, or maybe getting interpretations of how we have to do it. So for example, you know, what does if we want to fund over a weekend, we need to have the borrower sign something saying it's okay to fund over a weekend. What is that form supposed to have? Does it have to be signed by them? What if does the borrower even need that if we have no intention of collecting 3 days of interest, or even over a weekend we don't? Do I still have to get it out? So operationalizing that and getting a sense what the state wants could be a challenge. And I know it's a challenge even for the state. There's not a lot of guidance on this operationalizing it. So we do the best that we can. So really, I mean, ideally, what I tell my clients is, you know, if you get it would be best to have a per diem disclosure that says, if you want to fund over the weekend, check yes or no. And by the way, it'll cost you this much per day, which collectively is a total of X amount of dollars. Show my preference is to show both the per diem per day and the total of per diem for that period, because it could be 3 or 4 days if it's a holiday. But that's ideally what you would like to have. You do want them to check the box, right? Because if they don't check the box, then it doesn't tell us anything. So that's going to be a challenge to make sure that gets done. You know, we want the disclosure, of course, in the file, but ultimately, and this is where I think our challenges are operationally, this is a post-closing process, pretty much, the reconciliation. And we are very focused on originations, and once the loan is funded, we move to the next thing. Post-closing is more about shipping to investors. That's what we typically think. But increasingly, with now we have closing CDs and others, it's becoming regulatory as well. So we have to make a commitment that we have post-closing processes that will reconcile and true up certain things, including this per diem, which we can do. So it's just a matter of making sure you have a post-closing process to handle the reconciliation and be able to explain that to the regulator in an examination, because they'll want to look at that. I do understand that in some cases, you know, we've had some follow-up and renewal explanations on how to handle this, 3 years ago on per diem. And I think the general consensus is you cannot use a closing disclosure to validate when it was dispersed. That makes sense. It's circular because that's also the source document to find out if it's accurate. But we need something from the closing agent. Usually a settlement statement from the closing agent should be sufficient. I'm sensing that the DFPI is requesting disbursement ledger to reconcile it, because that's the more real document supposedly, and that throws us a bit off, because disbursement, those ledgers are owned by pretty much the closing agent, the escrow company, not us, so it's hard to get that. But just be thoughtful and heads up that in an examination you might be requesting that. They might be doing that as a source document for examination only, and not they expect it every time. I don't really know, but I have heard there's been the request for disbursement ledger I think in the context of a pre-exam questionnaire. But we know about per diem. There's a lot to talk about here if we wanted to. Jerry, your thoughts on that and your experience?
Really, my only experience is that they are incredibly picky about it. And if they see, you know, back in the day, it was rare that somebody didn't have to make a bunch of disbursements post-closing because they got the per diem wrong. And most people's systems work fairly well now, but they still view this as low-hanging fruit. And if they see anything that looks even slightly wrong, they're likely to dive in because they know there's going to be more. And you just need to keep it as clean as possible.
Agreed. And again, and for good purpose, again, we don't want to charge more than we're allowed to. It's just committing to the process, I believe, is the distinction. Jerry, loan products.
Yeah, so California has some very specific disclosures for certain IOs and ARMs that in the present world make a whole lot less sense than they used to, particularly since they were all drafted before all of the changes to the disclosures on the federal level. And it's pretty unclear at this point what exact disclosures are required. And with the market moving the way it is, we're all starting to see, I think, more of these sort of products because nobody seems to want to pay the current interest rate. So that's something that we all need to try to get ahead of because there's going to be a lot more of this. I've heard that this may be the market as opposed to part of the market. And California has actually been fairly good at answering questions as to what disclosures might be needed for what kind of product. But then, of course, they won't put it in writing, and who really knows? So that's something we need to watch out for. Again, be careful as specifically what kind of license you're operating under, because those disclosures vary. Certain of them are only required for certain sorts of licenses. Others, they don't seem to care as much. But you'll find that many of the doc providers are not set up for it at all. So we have that going for us too. We've had to cook up a few disclosures on our own just to make stuff work, kind of like the old days. Non-traditional and subprime, they're coming back with a vengeance for all of the same reasons, and they still have all the stumbling blocks they used to. Hopefully people have better practices, and the concept of what is a subprime or non-traditional is certainly changed over the years. 10 years ago, what they consider subprime and non-traditional now would have been right down the middle of the ballpark. So make sure you get that stuff right and follow all the various rules for HELOCs and anything that's a subordinate lien loan, the smaller loan amounts, the fees will almost always cause some sort of a problem on a smaller loan amount. And particularly with institutional lenders, that can be a real problem, but banks need those things for their CRA brownie points. So there's always a market for the smaller loan amounts. It's the bigger stuff that can sometimes be a problem.
Agreed. I think I agree with you. I think I'm seeing with clients doing more ARM loans anyways. Don't think I've seen interest only yet, maybe some, but the ARM loans. And one of those things is you don't want to just assume that your system is ready to do it, because we haven't done ARM loans in what, 13 years, not in a bigly way, right? So we haven't really done ARM loans a lot, but so always, like we do anytime you do system testing, you want to make sure that you have, are you collecting the data point that you need? Is the information correct? Is it mapping correctly? And ultimately, is it manifesting any mathematics later? If there's anything like index and margin, is that adding up correctly? So those are times just those you want to look at it. Sometimes you can just eyeball it, but again, if you want to have the right either disclosure or documents, you want to make sure you look at those and can speak to it. Traditional, non-traditional, that was those statements back in 2006 and 2007, I believe, respectively. And when you come back with non-QM, some of those triggers are coming back. I would say a lot of the issues that they were worried about are outlawed by Dodd-Frank insofar as in those statements, but don't make that assumption. You want to get familiar with, is your non-QM product triggering a non-traditional or subprime? And if not, that's okay, but at least you did the homework, not make the assumption that it didn't. And yeah, like we talked about the other things, subordinate liens, I think that's where things are going, junior liens, HELOCs, that's all good. But remember, there are certain requirements that might be triggered, like in the CFL law, smaller loan amounts. I mean, it depends. Real estate owned 10,000 less, and we're really going to do them. But the question is, don't assume that all the same rules apply. Some things might be different because it's a junior lien. Some will trigger because it is a smaller loan. Of course, HELOCs is a world of its own, and there are laws on that on the civil code. So you want to be able to be conversant on this, because in an examination, that's what you're going to be asked about on your loan product. How do you know? And we've gotten very comfortable with the Fannie stuff, for example, in 13 years, that we have to kind of maybe polish up some of our speeches on these items here.
Yeah, next page. There we go.
So trending issues, things I've heard and have been dealing with, and I'm just hitting a few because it's interesting. Under the DFPI RMLA examination, I hear that there's some questions about the owner's title policy and also the disclosure of pricing the owner's title policy. If you are getting goosebumps, that's because I'm touching upon TRID. And I think that's maybe where they're going as well, and they'll be asking that question. So what are we doing with owner title policy? Are we pricing it correctly or disclosing it correctly? And ultimately, is the borrower getting, I guess. For CFL, I thought this was an interesting issue. I mean, this gives you an example if you think the laws, but in the CFL, and I must have, had a client had to realize, like, wait, we can't do this. No, you cannot charge more than one appraisal in a 12-month period. Yeah, but what if you came back and refinanced in month 9? And so I went ahead and did an appraisal again because I needed an appraisal. It's like, yeah, that's great. Anyway, CFL law specifically says you can't do that. So guess what? You're going to have to do an analysis, year over year for same borrowers. Did you collect appraisal fees or not, and refund them otherwise if you weren't allowed to charge them? I go back to, you think you get comfortable with what you know and you don't see. And again, it's in the law. I'm not faulting them, saying this is where it was. The things we might not think about. So the sub provisions, they are looking at some of the smaller provisions in the laws when they're doing examinations. Foreclosure activity, I think there's some questions by the DFPI. I think again, in routine examinations, looking for information regarding foreclosure activity, and I think really in the context of COVID, right? So, so we know that we've got, of course, provisions in California about protecting borrowers and loan servicing, and I think they're really focusing here now on what did you do in COVID in light of the requirements. So be aware that might be something that comes on the radar in a state examination.
Also coming up from the Multi-State Mortgage Committee. And the larger servicers are having to file these monthly MMC reports, where they specifically ask questions about all of the foreclosure activity, not unlike those reports that were done to California a few months back. And they're going to have a laser focus on that.
Correct. So I think if we're talking servicing in an examination, if I had to guess, on a routine examination, that's not a servicing examination specifically, but it's a general one, I think this is where they're going to go, is foreclosure. One of the things that have been cropping up a little bit as well as a concept, and I believe it's coming up in California too, is the AML, I'm sorry, the AMC fee. So where we obviously have a cost for appraisal, but is there a split between what we pay the management company versus what the appraiser is actually paid? And I think that's difficult to manage through, because I don't know that we really know what that split is necessarily. But I think there might be a trending expectation that we should be able to bifurcate that which goes to the AMC versus the appraiser. And so keep in mind that could be something that bubbles up, and be thoughtful with it when it does come up. I don't know what the right answer is or the right approach, or whether this should be an examination point. That, I'm just saying that that's what they're coming up with. So that's something in California in particular, I think, in examination. Now, one of the things about as well, and I say training considerations, this is always the issue here, is dealing with findings that maybe are not findings. And I have no reason to believe that any regulator wants to issue a finding that they otherwise cannot back, but maybe there's either misunderstanding factually or sometimes legally as well, the interpretation of the law. And so when you get a finding, first find out whether the finding is valid, right? So you got to find out, does it make sense? Are they correct? And sometimes their presumptions are well-founded, but not really founded in law. So what I'm finding a lot, in fact, and this is not so much the DFPI and examinations, I would say that's any examiners, or particularly actually now more due diligence companies. So just an idea, the concept is that we get so embedded and comfortable with the requirements that, hey, this 1003 needs to be signed by I'm making it up, right? This needs to be signed by the loan broker, and otherwise it's a finding if you don't. It's like, well, I don't think there's a legal requirement. I think Fannie requires that, but this is a non-QM loan, so it's not going to Fannie. So I don't think the requirement is triggered. So first of all, I don't think it's a legal requirement, and secondly, even if it were a requirement, it doesn't apply in this transaction, so therefore it shouldn't be a finding. So it's sometimes just understanding where the source of the requirement, and I put sometimes requirement in quotes, requirement is coming from, and understanding the finding before we say, sure, we're going to do that, right? It's understanding the finding, and sometimes it's having good conversations with the examiners. They'll understand, like, oh, that's where we thought it was this, or based on that, and then the finding maybe goes away, or it's a better understanding, or they recraft it in a way that really reflects the real issue that we're talking about. But these are the kind of things, these are trending considerations that we want to think about, and I put it here is because I see it more in non-Q, and frankly, I saw it more in due diligence companies or investors than regulators, but I can see it coming up there as well. So just a thought. Jerry, I'm assuming your thoughts on that, or are you a bank, so it doesn't matter?
Well, it always matters.
Yeah.
We still sell most of our stuff, and there's also the flip side of that, because we also got used to Fannie being kind of loose on a few things, and with the market changing and using third-party purchasers, some of that's going to get tightened up. That's not an exam issue,
Correct.
But it is a real-world issue. And another real-world issue we're running into is with all the Ginnie refinances that people are doing, the FHA stuff, is seasoning, because people were starting to refinance fast, and there's a certain time period before you can put something in a pool again. And Ginnie is coming down hard on pretty much everybody in the industry about that. So it's another thing to watch.
Okay,
the next page. Yeah, this is a good waterfall. Consumer protection first, risk on the license.
Correct.
Profit probably goes in that third one. That's not the way a lot of places looked at it in times past.
Yeah, what happens is, we're not going to have the ability to, sometimes we don't have the ability to hit all 18 things all the time, right? So there might be 25 points. Actually, I did the math once. I think it's 200 points of risk that we have to manage on a regular basis. I wouldn't say daily, but regular. If you include vendor management and information security and everything else, there's a lot of 200 questions you have to answer to find out, are you in control in these things? So there's a lot to cover. And if you have all the resources, that's great. If you don't, you're not excused from it, but sometimes you might have to do some triage and find out what's most important to address. So yeah, oddly enough, I think you're right. I think, Jerry, I think profitability is probably the last thing to worry about in the context of managing our risk, at least from our perspective when you're managing risk management. I'm not saying business shouldn't consider it. I'm just telling you risk management, that's not as compelling as consumer protection, which is the first thing you have to worry about. Is the consumer being harmed? So if you got something that's extremely important, that's more consumer centric, we definitely have to put things in place and make sure we have that in place, so we can explain we're doing the best we can to protect our consumers. You know, the next thing might be loan saleability. They usually have to have a business, so that's not profit, but that's loan saleability, risk on the license, consent orders, etc. So you kind of have to measure that. Okay, in the 200 things I have to hit, and I'm rolling up my sleeves today, which am I going to hit? You kind of have to hit sometimes some priorities. Again, I'm not suggesting not to comply on things. I'm saying sometimes you have to pick your battles first for today with the resources you have. And so spend some time on figuring out what those might be. And I think, again, I think regulators, et cetera, would understand that for this. And that's why they say things, depending on the company size, the expectations may change. So take that to heart. You know, as I always say, if you have a C amount of resources, you know, put out B+ work. That's still okay, right? You're still exceeding with what you have. So I think that's important, but spend some time thinking about that. So, and the reason why I bring it is really this bullet point here, which is, as I always say, some people have heard me say this before, I've been saying it for years, be able to explain your risk position, you know, your 45-second speech. So, you know, why are you doing this? If an examiner will ask you, why are you doing this way? Be prepared, like, oh, we considered that. We're aware of it. We considered this. We look at it this way. We looked at the law. We looked at also the volume that we have on here. We have a double way to look at it in case something is harmed. We do fix it. But there's a reason why we approach it this way, and this is why we do it. And it's got to be quick. It's got to be tight. Make sure it's correct and it's honest, that you did your due diligence behind it. I know behind 45-second speech is 3 weeks of work minimum, right? But you nail it down to a 45-second speech, so people, the examiner looks at you and says, oh, that sounds reasonable. Because remember, they're about being reasonable. It's some things they have to make choices, and if you can explain it to them, they're like, oh yeah, that makes sense. That's what we're looking for. And you should be able to identify which one's which. This goes back to the waterfall as to which ones did you work on hardest, et cetera, and put resources behind. So really, at the end of the day, it's your 45-second speech you want to focus on.
And
Lastly,
one thing to keep in mind, in your 45-second speech, well, we don't do it that way because it's too expensive is typically the wrong answer.
Right. Well, you know, Jerry, it's funny you should say that. I actually had, in an examination for a client, it wasn't California. So we gave them the financials, and one of the pre-exam responses looking at our documents was, why are the owners taking so much money out of the company? And I was taken aback, like, I want to say it's none of your business. I mean, I don't really actually know. I don't handle the accounting of the company anyway, but that was a question, and I thought about it, and I submit, you know, some of the thoughts could be that we shouldn't, you know, maybe, just maybe, examiners or maybe are tired if they keep hearing, I don't have the resources for that, or you know, it's very expensive, etc. Maybe they'll come back with, well, I saw that you took this money much out of the company, CEO, so if you kept it in there, could you have hedged it? Maybe that's where they're going with it. I do not know, but it doesn't matter. I think we do have to understand that saying that we couldn't afford it doesn't matter. I think what we do have to say is, for a company our size, we did what we could and what we thought was reasonable, and no consumers were harmed in the making of the loan, because that's always the first one you want to think about, is consumer harm. Lastly, I think is our last item, is examination response, and that's not really preparation, but it's response. Make sure, you know, we always do this, make sure the finding is accurate. The DFPI is going to be there for, I don't know, really will focus on you and you alone for a course of a few weeks, at most a few weeks, right? So, because they have other exams they're doing it. So it might take 2 weeks or 2 years to get their exam response, but the truth is that they're not only focused on you. You're there for 2, 3, 4, 15, 20 years, right? So when they have a finding, maybe it's something we misspoke, or they misunderstood, or didn't have all the information. Make sure the finding is accurate, first of all, that the understanding was correct. And as well as between the law, regulation, and the facts, right? It's okay to go back and say, is this what you mean? Is this how we do it? Is this what the law really means? And by the way, did you understand that we don't have wholesale, and that's why that's not an issue? Making it up, it's something like that. And then be cautious in over responding, right, or over complying. So I know it's great, like, oh, the examiners, they want this kind of a thing, they were upset with it, or they wrote it up and they're mad. It's like, they're not mad, it's a finding. So we're going to do this, and we're going to do it 9 different ways. Well, I don't think even the examiners or the DFPI is asking for that. They want a reasonable response with reasonable controls for a company your size. So make sure that your response is balanced between the law, regulation, facts, and the company your size, and that the examiners, in your response, the examiners have the opportunity to say, hey, if you don't think it's enough, let us know. We'll fix it, but we think this is reasonable for the type of finding that we had. And my experience has been very good about that. So really it goes back, don't over comply. Sometimes they might ask you to, but maybe again, they don't understand all the facts or whatever. So it's a negotiation sometimes. Will this work? Is it okay if I do it monthly instead of weekly, right? And if it's not in the law and regulation and they understand that, maybe it will. So balance your response, I think, is important. What is your thoughts, Jerry, on
Yeah,
that?
everything you said. And one thing we've been running into quite a bit, we're a largely correspondent operation, so sometimes there's multiple documents floating around where there'll be a citation that, in Joe Smith's loan here, that we didn't find this, and this disclosure, and they don't bother to put that in their intermediate stuff. They just put it in the final report. We have had extremely good success at clearing multiple findings just by, well, actually, here it is, show it to them. It goes away. Just the fact that they made a finding doesn't mean that it's written in stone. And you can almost always get them to make a change, assuming you have a really good story about it.
Exactly.
And so I remember not that long ago, we had like 2 pages of findings in some exam, and every single one of them went away because we were able to do the follow-up. So if you get a bad exam report, that's not the end of the world. What matters is what the closeout letter says. And often they say that any findings have been cleared. Have a pleasant day.
Correct. So I think that's pretty much it, Jerry. Any final thoughts? I know we'll probably go into questions. We have a few minutes. I think there's 1 or 2 we already have. So any other final thoughts, Jerry, and then we'll go on to questions.
Not really. Let's see what the questions are.
Okay, very good.
All right, we have had a few questions come in. Let's see what we have here. The first one asks for you to please restate the 3 different interpretations of funded loans in the various departments.
Oh, sorry. Okay, now careful. I'm not saying this is said in law, okay? What I'm saying is, and I'm glad you asked the question, if we're sitting in a company meeting and if I ask someone, did we have a funded loan? It depends on who you ask, right? So accounting will say, if I funded the loan into escrow, right, or to the closing agent, not yet dispersed, so then that might be a funding. It's not for my purposes. I think, and Jared, let you disagree, but I think a regulator wants to know that I disperse a loan, really close it out. It was dispersed and it's done. That's a funding to me. And the reason why I say that is if a report's asking how many loans did you fund, I think that's what they're asking for. They're not asking for the CFO's definition, or they're not necessarily asking for the funding department's definition, which is, well, we sent it out to get wired. Really the question is, did we really disperse? And that's really what I'm talking about. So I'm saying careful, don't make that rule of law, but I will say it's a good question. In a meeting, when someone says, hey, we funded a loan, it's like, okay, what do you mean by funding? Because that might change. And that's where you get report discrepancies sometimes, is where I get it from accounting and they misunderstood what I meant by funding. So get the clarity before we submit reports. That's kind of my point on that one.
Yeah, and then if you throw rescissions on top of that, and maybe there's 4 definitions. I mean, things can get pretty complicated.
This is true. This is true. By the way, I do, Samantha, real quick, unless you have a question, I do know there's a question around fair lending. Do you have one there?
You can go ahead, and if you have one, you can answer it.
Yeah, I know there was a question on fair lending, and the question was, is the DFPI doing anything regarding fair lending insofar as in their routine examinations? My experience so far is no. Jared, do you have, I have some thoughts on it, but do you have any experience that they're actually looking at that right now?
In my experience, they're not prepared for that today.
Right.
Tomorrow, they seem to be really starting to look into that. They're asking a lot more questions, particularly in the COVID-related stuff that could be fair lending. We know they have access to, of course, all the HMDA data. We know they and their buddies at the Bank Supervisor National Group take a look at this stuff, and that they talk to all of the various AGs. I would be really surprised if within the next year or 2, we don't see something coming out of this department on fair lending.
Agreed.
And it could be something very unpleasant.
And well, what I would say is, I recommend to all my clients to do something, depending on the size of your company, do something for fair lending. We should anyway.
But you
And
got to get
and and that can simply say get a vendor to at least crunch do HMDA plus data search and kind of tell you what your performance is. There's no reason we shouldn't do that. So I believe you should take some action for that, regardless of an examiner is going to ask for it. You should lean into it anyway, because we know you have the data. You maybe need some help getting it looked at, and then get the help. That's what I would recommend.
Yeah.
Okay, Samantha, thank you for that.
Yeah, no problem. We do have a few more. So have you had any experience in California exams with regulators asking for copies of certificates of loans to one borrower from non-bank mortgage lenders? If so, what is the stated basis for such a request?
I'm not sure what a certificate, Jerry.
Well, it sounds like it. I'm not aware of a non-bank loan to one borrower limitation anywhere, but they may be looking at it from a safety and soundness standpoint. I'm not sure. But basically, in the banking world, there is always a limitation against the bank's capital of how much you can loan to one borrower. And it comes into play in really large loans. I have never seen the issue come up in the mortgage world, but I suppose it's possible. It'd have to be a pretty small lender to get anywhere near something that would affect capital.
We have one more. Does the closing statement need to be date stamped, signed, or just print date? Okay.
I'll get my magic 8-ball. See what it
I
says.
know. That's all I've got.
I think, and again, in good reason, I believe sometimes that it's not clear, right? And admittedly, I don't know the answer top of my head, the latest answer top of my head, and sometimes that changes in the examination, or the examiner might be requesting. But at the end of the day, the document we need, we're talking about per diem here, right? I need a solid document that shows that, yes, this is the document that tells me that in fact, this is when the loan funded. Now, I believe you can even get an email from the closing agent that says this is when the loan funded, and that might be sufficient. That leads me to believe that you can get things that are printed and so on and so forth, right? But sometimes it's totality of the question, what else do we have in the file? Or, I want to be careful that we're not only relying on emails when in fact we could have gotten settlement statements. But it really goes down to your best evidence as to when the loan funded, and as a matter of practice, if you can get that, you should. I mean, get the best evidence, signed, final copy, so on and so forth, is the best thing, is better than anything else. If it's less than that and that your approach is that's also okay in certain situations. I don't know if I would do it as a full policy. My point is that I think there's some muddled area in there, but because I know they said we want something signed and we'll accept an email. It's like, well, if you accept an email, and you shouldn't have to worry about it being signed. So I think we're still, oddly enough, still growing into that a little bit, even in this day and age. Jerry, what's your experience, if any?
Yeah, they vary so much. We actually do a post-closing audit to make sure we have something in there that we think would pass an exam, which is the real answer for us. Would this make an examiner happy? We're fine. If it wouldn't, we make sure we get more documentation that will, and particularly with recording fees and things of that nature. And plus, when you get to real closing statements, once a final, anyways, there can be 5 or 6 of them.
Yep. So the relationship with your closing agent is a really good idea. A good relationship with your closing agent is a really good idea.
Yeah.
So, well, I think that's it. Any other?
Yeah, that's the last question we had sent in. So thank you both for joining today. Thank you everybody else who's tuned in, and Raymond and Jerry, you guys were great. Thank you for all this knowledgeable content. Any last words before we sign off?
No, just thank you for the opportunity to hear me talk, because, as everyone knows, in this business, I love to hear me talk. Thank you very much.
Thank you guys for your time.
Thank you all. Have a
Take
good
care,
day.
everyone.
Thank you, Jerry. Thanks, Jerry. Bye.